Okay guys, so the Zoom did actually corrupt, so I'm actually going to go through just on a quick video what I actually went over in the last Zoom. Basically, a lot of people were asking about the entries and how I get tight entries, tight stop losses with very, very little drawdown. And this is literally just due to entering off of order blocks and liquidity zones. So a lot of people are confused with actually how to find liquidity. So if you think of it as liquidity is pretty much where there is money in the market, where there are orders. So to identify these zones, we're looking for order blocks, so-called support and resistance zones, where prices come down to test multiple times. As this area here, we have a lot of a build-up of wicks in this area, and when this happens, price usually comes back to test it. This is what happened. Created, you could say this candle here is the order block, and if we draw that like that across, you can see inside the liquidity area we've got the order block, and the way I get the tight entries is setting a limit in line with the top of the order block. So you have the top of the order block here, you set a limit there, and the way you can get tight stop losses is actually to put your stop loss just above the wicks, so you know that if price breaks above this, then its order block's no longer valid, and then price could continue higher to the next sort of zone. So when this actually happens, you want to be in the market at the optimal time. So that's why I say the top of the order block, because a lot of the times price can tap into the bottom of the order block, drop a little bit, people are in profit, and then come up and take the top of the order block. So that's why I personally enter on the top. So when you're looking for targets, just target the next order block or the next liquidity zone, the next imbalance fill. And as you see in this area here, we've got order block, we've got an imbalance ready to be filled in this area. And if we actually draw this across, you can see the area where you would have targeted got hit and then reversed. And again here, let's say you entered off of this order block here, the bottom of the order block. You've also got a zone in this area here, so we've got an area which has been tested once again, tested again. So this is where you could buy stop loss just below the wicks, and right now you're almost up 3%. You would have been almost up 3% even. So you see that area tested once again and then reversed, and with your stop loss you can get like 3 pips, 2 pips, but depending on the spread, if you don't have a raw spread account, then you won't obviously be able to actually enter with like a 1 pip stop, 2 pip stop. You have to just add your spread on top. But if we actually go on gold now, the way you can use this is pretty much the exact same, but the stop loss obviously won't be as tight. That doesn't matter because obviously gold moves a lot more than the majority of the pairs. So same thing here. During this move down, we have a lot of institutional candles, and the way you can pick which ones to use is pretty much based on the trading times. So when price is actually in this area, it's London session, and although we do have this so-called order block here, when price actually comes into New York session, that's when we're actually looking to enter our trade. So we wouldn't be focused on when price is at the order block when it's not in our trading times. So we'll delete that and focus on this order block here. And then remember I said set the limit, and then you can put your stop loss wherever. Gold, either 30 pips or less stop loss. So you could put it above this candle here, because this order block's been taken already. So this is the imbalance, the last imbalance candle down. And for targets, the last imbalance candle here, which caused the break of this retail trend line, was caused by this candle here. So that would be a good target area. And as you see, bounce, and then we shot to the upside for a nice 1 to 6 risk to reward on this trade, like that there. However, a lot of people like entering the fibs, and you can use this as well. So when you're waiting for those 3 taps on the fib, if I find a perfect example of this, Remember I said about the 38. So if I actually edit this and add the 38. Okay, so I know a lot of you actually trade using the imbalance fib sort of style of trading. So if we actually look on gold here, you can see that when price is like this, it's not really creating many imbalance candles, as we've been creating imbalance, filling imbalance, creating imbalance, filling it straight away. So if you look back when price was creating these imbalances and wasn't filling them straight away, you can see this more clearly. So when you're actually drawing the fib, you go from the imbalance to the last bit of the imbalance, and you have this area here. So when price is actually in this area, if we go down to the lower time frames now and we go back to this area, you can see what happened. So the first time price came into this area, it was I'd say a couple of hours into New York session, and this is usually when I'd be looking to enter, but by going down to the 30-minute and actually looking for the entry, you can get optimal entries. So what is happening here is a build-up of liquidity, and when this is happening, remember I always said it, price has to grab the liquidity before making the move. So with this big push up here, what's basically happening is the banks moving price up, getting everyone in, also stopping out the early sellers here, stopping out all the people that are selling here with their stop loss just above, stopping them out, moving price higher to get in at a higher price. You probably see a lot of smart money, people call it premium and discount zones. That's pretty much what it is, and they're putting it into a premium zone, so they get in at a higher price to then short it to the downside, which means they make more money. And also the way they make more money is also to stop out the people that are entered early, or the in the buy positions on this impulse, the impulse push up. So when price actually grabs this liquidity, this is when you can look to enter. I mean, this is in New York session anyway, although it is fairly later on. If we actually go on the 4 hour now and have a look at this, you can see on here it just looks like a tiny bit of consolidation, a big wick up. However, remember what I said about liquidity and consolidation always being retested? This zone here, if we draw it back, still a zone. You could see it as like a supply and demand, like that sort of kind of trading, but also we have it in combination with the fib, and you can see that the zone which has been tested and the liquidity has been actually formed at is then retested to perfection. So the way you can do this is you can either set limits or just enter it as price is happening. But let's say you entered there, where would you put your stops? Just above here. The reason for this, you could be safe, put your stop above this order block here, but you see this last wick up here, this is kind of the area where we'd look to put our stops. So if we put our stops just above that wick, you can see in line with that wick, it pretty much made an exact horizontal line across and wouldn't have stopped us out. I usually aim for a 30 pip stop, but 33 pips doesn't really make that much of a difference. Obviously you could have probably got a tighter entry when price was actually in this area. And where would you look for your targets? Simple, this area here. So this was the low from Tokyo, and if we actually draw this across, you can see there, bounce in, break the low, retested it. So the same thing that's happened up here with the break and the retest of this zone, we've had the same thing happen here, creating liquidity. People are buying, we've tapped in it again, people are buying still, they're in profit, they're happy, maybe they're adding more positions. Price tanks through, stops them all out, and then the sellers are in profit, reversal, and price goes to the upside. But you see, when we're creating double bottoms like this, there's always ways to get entry. Remember I said order block, sell limit here, the buy limit even here, boom, you're in, tight stop. Let's say you had that like that. So remember I said stop just below the wick, 14 pip stop. Where could you target? First target could be this order block here, untested, this order block untested. That's a 1 to 15. You can roll your stops when you see the momentum continuing. Next target, this order block untested, this order block untested. This one kind of tested actually. I'd say this order block would have been a good target for gold. You see a 1 to 23. You've caught the shorts, you caught the longs. You only need, this was about just over a week in trading times. You need 1 or 2 trades like that, a month even, 11%, 23%, 34%, 34% on a 100 grand account, 34 grand, you'd have to trade again for that month. Obviously, if there are potential trades and you're catching these quite regularly, if you're trading other pairs, for example, then you can make more money. But there's no point trying to trade every single day through all of this when there's just no setups presenting themselves. Just wait for the perfect setup, and in doing this, if you have a solid trading plan and a risk management plan, your profits in your account, you'll see a lot more wins. Your wins will be a lot bigger. And when you're using this tight stop loss, I'd much rather lose 14 pips than those traders that have a 60 pip stop to give it so-called breathing room in the area. I mean, if price breaks this low, then we're looking to fill this wick here, or come down to this order block. So I don't want to be having massive stops just in case price goes down. If price goes down, I lose 14 pips, great, doesn't really matter, it's only 14 pips, on 10 lots, that's 1.4k. If you win, that's £33,000. So the wins definitely outweigh the losses with this trading. You think 30 wins, 30 losses even, is pretty much equivalent to 1 win if you're using this good risk to reward and sticking with the same sort of risk per trade. We'll actually look at a few different examples now. You can see this exact thing happened on GJ this week. So we had this high created, and then we did have price in this area here struggled to break above the high. So we created a new high, struggled to break above, and this area here was formed. Remember I said top of the order block to get the entry, this level here, sell limit placed here, stop very, very tight just above the wick, 6.8 pip stop. Where do you target? You could target this order block, you could target this order block, you could target this order block, plenty of targets. And you see, as price is going along, the same setups are just forming again and again. This one you wouldn't have got an entry on the top, but price tapped into the order block. Again, order block left here, price tapped in, dropped. And remember I said these zones, so you have the zone, liquidity, testing the zone multiple times. What does it do? It breaks below, wick in, tests, then drops. You always see price retest these sort of zones before we actually make a push to the upside, and that's what I found anyway. But you see, one GJ move from the 21st of October to the 22nd, so 24 hours or 48 hours even, you've made 31%. 100k account, 31 grand. A 10k account, 3.1k. So you don't even need big accounts to make decent money with trading like this with these tight stops. You literally just need to find the setup, let it ride, let it hit your take profit. You see, a lot of people, they saw price move down. With this tight stop, they're like 2-3% in profit right now. Well, they moved their stops to break even. Price came up, tests it, stops them out of break even, drops down 31% in profit. They're like, oh, I should have moved my stop to break even. But then I'll do it again in the next trade, because of the psychology. This often happens when they're either over risking or they're just sat on the charts watching the whole time. What you should do, enter your trade, you've got your stop loss set in a perfect place for a perfect reason. You know, if price breaks through your stop loss, then the trade is no longer valid at that time. Your TP set where the market has to come to. So why would you sit there watching your trade when everything is set out to just leave it? The more time you're watching it, the more time you spend watching your trade, the more inclined you feel to close out when you see it going against you. Like, for example, this area here, we pull back up, you probably would have thought, oh my god, we didn't break the low, we got to close now. This is what they want you to think. Then price breaks the low, comes all the way back up to test the same zone again. If you weren't watching, this wouldn't have mattered, it wouldn't have affected your psychology at all. Trade would have been playing out, doing what it wants to do, and then we have the drop. However, if you're watching and you're seeing, you know, from here to here, it's probably about 5-10% profit is fluctuated. And, you know, if you're watching and you see, let's use a £100,000 account as an example because it's easiest. You know, you've just seen £10,000 go from your profit. You're obviously going to want to close because you think, oh, if it's just gone up 10,000 into the profit that I could have had, then it could just go up to the stop loss now. Instead, you've just got to think, if I wasn't looking at this trade, I wouldn't have been tempted to close. It would have hit my TP. And you've just got to trust your analysis pretty much. And that's what I've found a lot of traders actually struggle with the most. If we look on a few other pairs, you can see here, exact same thing on EU. So you have this zone here. You could say this order block's already been tested. However, price did actually come back to retest it. And also, if we actually draw the daily fib, or the 4 hour, it probably would have lined up as well. 4 hour, you can see, look at all these taps into the 70. Extra confidence is the price is going to drop. So, if I actually get rid of this fib now, this area, boom, tiny stop above the wick, boom, drop down to this level. Remember I said, these sort of levels, boom, wick in, test it, because these are areas of supply and demand. There we go. Areas like that. Price just trades between it. Sell here, buy here. That sort of thing. Also, if we look at GU, looked at that one, GA, interesting pair, this one. I know a lot of you did actually catch nice sells on GA quite recently. So yeah, you see, wick down, entry here. If we actually zoom in on this entry to show you a better detail, you can see price came down. Remember, imbalance area has to be filled. Price comes up, fills the imbalance area, and what is that imbalance area? In line with 1.8900, which is a psychological level on GA. So we know that price has to come back to test these levels before dropping. So the confluences on this are just insane. So we've got 1.89 level retest. We've got the 70% fib projection and multiple of the 61. We've got an imbalance filling and Tokyo session, which obviously Aussie dollar moves quite a bit in Tokyo session, or the Asian session. So wicks in to the trade, and if we zoom out here, you can see tight stop, trail the stop down, you know, between these levels. I did a YouTube video on this as well. I don't know if you guys seen it. You know, you've got 1.88, 1.87, 1.86, 1.85, 1.84 just broken. So let's say you close at 1.84. You know, you've got 1 to 66. Each zone from psychological level to psychological level on GA is 100 pips. So with a 10 pip stop, each zone, you're getting, you know, 10R, 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 10R. Because we've got a 7.5 pip stop from 1, 2, 3, 4, 5 zones, you know, 500 pips, 1 to 66. And here, you've got a re-entry or a scale in, order block, sell limit on the top, tap in, boom. what's that? An extra 30%. Again, what did price do? Has this zone here. Came back, tested. Boom, drop. Another very, very nice trade. If we draw the fib here, boom, tap in. If we look on a 30, 1, 2, 3, 3 taps, drop, you're in lovely profit. You know, from this a few week period on GA, actually month period, you know, you could have made well over 100% in profit just from risking 1% from scaling in. Holding your swing positions and day trading along the way, and you can make some serious money from trading with these tight stops. So yeah, it's annoying that the Zoom did corrupt, but if you've got any questions on this, be sure to let me know in the questions tab on the Discord, and I will answer them as soon as I can. So yeah, see you soon.